Good morning, Henry. Delighted that you've agreed to come on the Move IQ YouTube channel this morning because I understand you are the man to ask the questions to about all things money. A housing market needs money to function. So a lot of our viewers have been asking us recently are the banks open for business? Is it possible at the moment to get a mortgage?
Yes, I mean, clearly there's been significant change. But the banks are open for business. They have been hit very hard with regards to all these payment holiday requests. So the limitations really are around their operational capacity more than it is a sort of liquidity issue. So we have seen the banks pull back as a result of simply having to redeploy, a large number of their staff into telephone helplines and the like. But they remain open for business. But there's definitely some banks have been harder hit by this than others. For example, Barclays would have been particularly hard hit by it. HSBC, their operational capacity seems to be in a much better space than say Barclays. So it changes from lender to lender. They will work this through, and as they work it through, I think you can expect the availability of funding to improve as their operational capacity improves.
So you're saying their challenge at the moment is operational, as in they haven't got enough people to answer the phones to do the business. People are needing to work from home or
I mean, that's certainly part of it. People who've had to isolate, people who have had to work from home. Some of the banks have got overseas call centres, particularly in India. Those have had to shut down, and so that capacity has gone. And to put it into perspective, I think NatWest actually published figures just recently. I think their call volume went up to about 25,000 calls a day, which was a tenfold increase on what they would normally have.
Yeah.
And you're trying to find the capacity to handle those helplines from a staff that's already short and working in different ways to where it was before. So, it's been a monumental effort for them to sort of handle what they've been asked to do.
But aside from that, it does feel that the banks have got lots of challenges at the moment. They're in business to lend money. That's what they want to do.
Absolutely.
Aside from people unable to look round houses right now, but the valuers can't look around houses. And therefore, they're going to have great difficulties in actually assessing whether they're prepared to lend the money, whether it's a safe mortgage.
Yeah, and that's true. But I think where we have seen there was already technology in the market to value property remotely without a physical valuation. They have these automated valuation models that rely on various algorithms in the background to value. They were already using that on purchases and remortgages. There's another tier called a desktop valuation where someone looks at the data and actually applies a valuation on that basis. And beyond that, there's actually another sort of there again where people can take videos of their property whilst in the property. They can be geolocated to that property so that the valuer can be totally confident that the property they're valuing is the correct property. And then they apply all the various data sets to those valuations. So actually, and what we have seen even in just the last 2 or 3 weeks is, for example, HSBC have gone to potentially up to 90% on an automated valuation model. Now, they don't work in every scenario, but they are working in a much greater number of cases now. Halifax also moved up to 80% loan to value on a number of these ABMs as well. So we've seen them move beyond where they were before. So that there's definitely, and it's not just the refinance where you can where a purchase valuation is required. It's happening on the purchase valuations as well.
That's actually really comforting. But of course, those clever algorithms rely on data, and I'm wondering how comfortable will the banks be to rely on sets of data in a changing market, and in a few months' time, where there haven't been many purchases, and people are still assessing where the world is and where their own lives are and where their own jobs and security is. If those clever algorithms haven't got up-to-date data to value, I just wonder how the banks are going to feel about that at that point.
I think that is a challenge. I think certainly months down the road, and how many months that is, I wouldn't know exactly. But I think, as you are right, that data does rely on an amount of transactions taking place, on valuation, some physical valuations taking place. My sense is that for at least 3 or 4 months, the data set should be okay for what they're looking to do. But beyond that, it would I would imagine it would provide challenges for them. Yeah.
And after the banking crisis, it seemed to me that there was a lot more compliance and a lot more regulation on the banks to make sure that we didn't get into the situation that we were back in 2008. And so that's to protect us, the borrowers, as well as the banks. Is that level of kind of regulation and compliance perhaps going to make it harder for them to lend and I am talking in 12 months' time?
I think the compliance, from a compliance side, we always have found that the mortgage market review, in particular in 2014, the additional affordability calculations that came in as a result of that, the stress testing, and the wider stress testing on the banks as well, has left us in a much better space now. The reason that the banks have the money to help support some of these businesses now is because of that additional stress testing that went on. And individually, the compliance and the advice that people have had to take with regards to taking their mortgage has ensured that people haven't overstretched themselves and haven't borrowed greater amounts than they were able to afford, albeit that we're in a very different environment and people's salaries in many cases have been obviously significantly affected. But from a point of not borrowing more than they could afford based on where their incomes were, then that's been, from a compliance perspective, that's been sensible. So I think it is more a case around the sort of risk departments within the lenders that will have a greater bearing on how we come out of this and how much they're willing to lend. Is going to have an impact on people's income. We're already seeing lenders restricting how much of someone's bonus they will take, how much of someone's commission they will take. If you're in certain industries and you're in a self-employed role, they're asking a greater number of questions around the future viability of the business and the future income streams. And that's, if you're a bank, in fairness, you're going to ask those questions. So
those questions were being asked before or are being asked now?
They are being asked now, I guess, with regards to, I think, banks have always looked at historic income figures. If you take a self-employed person, they're going to ask for the last 2 years' accounts.
Yeah.
In certain scenarios, they may ask for if we're a certain way through a financial year, they may ask for draft accounts. But in general, they've looked at historic data. But I think more questions will be asked now with regards to future earnings, in particular when they look at certain employments and certain trades, etc.
Henry, that's been super useful. I feel better about things. As I said at the beginning, a housing market needs liquidity. People need to be able to borrow money, otherwise we don't have a market. But it sounds, talking to you, as though actually the banks are relatively well set, but they have structural issues, they have organisational issues now, but other things seem to be in good shape by all accounts.
Well, I think so. I think we always say, you touched on it earlier. I mean, banks need to lend. That's how they make money. And they're not going to lend where they see much greater risk. But I think there is definitely lending there. And actually, if we do compare it to the financial crash, it is in a different place. The financial crash, trying to get anything beyond a sort of 60% loan to value mortgage was very difficult. We've still got lenders in there at 85, 90%. I mean, I think that the new 60% is probably 80% with regards to where they are. Yeah. Where they are now, where most of them are most comfortable, but there are some just going beyond that. And I think, as I say, as the operational capacity comes back, that will improve. And
there are some fantastic rates, aren't there?
Yeah, I mean, you've got rates of between 1% and 1.5%. So it is still very, very cheap money. And I think the other point I would make around the payment holiday side is, I would just encourage people to investigate their options when they're considering a payment holiday. I think it does need to be understood that a payment holiday isn't just 3 months without having to pay mortgage sort of free money. It is rolled up at the end of the mortgage, and it will add on to the mortgage. And whilst it won't affect the credit score of people, we do have concerns about how it might be viewed in 12 months' time. I think it is unclear what questions will be asked in 12 months' time. Mm-hmm. Around people taking payment holidays, and what effect might that have? I'd like to think it won't have a huge impact. I mean, but we just don't know that.
Let's see what the future holds, Henry. But I am feeling better about things having spoken to you, and I'm sure our viewers will be much relieved as well. That's been really useful. Much appreciated. Thank you.
Thanks, Phil.